Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, December 6th, 2022, and I'm pre-recording this Trading Places Live for just a bit later this morning. Let's see, futures currently up slightly. We got the Dow futures up 23, S&P futures up 4, NASDAQ futures up 25. Keep in mind, though, we do still have a couple hours to go before the opening bell. Crude oil prices down another $1.10, 1.4%, down just below $76 per barrel. And the 10-year Treasury yield down 5 basis points this morning, back to 3.55%. I'm continuing to watch yield support in the 3.48 to 3.50 area. I'd really like to see the yield hold above that, especially from a bearish perspective. If the yield were to break down, I think that just gives the bulls more ammunition. And quite honestly, anytime you've got rates coming down, valuations go up. That's just the way the market works. When you have lower interest rates and you discount future earnings or cash flows, depending on how you're valuing the company, you use current interest rates. And when rates are dropping and you're discounting using lower rates, it creates higher valuations. So if you are on the bearish side, you really want this 10-year Treasury yield to hold 3.48 to 3.50%. I think it could in the near term. It'll be very interesting to see what happens in the next inflation report, which will come out on Tuesday. That's the CPI that'll be out on Tuesday. The PPI actually comes out later this week. But that core consumer price index is what I'm watching. That'll be out Tuesday morning at 8:30. And then on Tuesday, also, the Fed meeting begins with the policy decision and policy announcement on Wednesday at 2 p.m. So we got a lot that the market's going to be anticipating. I think a pretty interesting part of this is going to be how the market plans ahead, if you will. The Fed has said, hey, we need multiple series of reports showing that inflation is back under control. We certainly haven't gotten that yet. So does the market sell off, stock market that is, sell off in anticipation of that report, taking no chances? Or does everybody decide, hey, let's go all in, because we've seen what happens when these inflation reports come in lower than expected? The market has absolutely exploded to the upside. So it'd be really interesting to see what market participants do heading into next week. But at least this morning, we've got futures up. We'll go from there and see what is in store as we go through the next week or so. Let's go ahead and take a look at today's agenda. So I'm going to start off with the daily market recap, jump into talking technically. EB top stocks. I'm going to go ahead and maybe include this as a regular feature, taking a look at some of the best performers in some of our key chart lists that we keep at Earnings Beats for our members. Then earnings spotlight, and we'll wrap the show up with the 3 you must see. Let's go ahead and first go over to earningsbeats.com. For those of you that are new, welcome. And to all those of you who listen regularly, welcome to you as well. We certainly appreciate your loyalty and your support. If you do go over to earningsbeats.com, though, and you're new, you can scroll down. You will find our free Earnings Beats Digest newsletter, where you can just simply type in your name, email address, hit that subscribe button. This is a 3 times a week newsletter that's published Mondays, Wednesdays, and Fridays. We try to get this out by about 8:30 in the morning Eastern. So try to get it out maybe about an hour before the market opens. Normally focusing on things like relative strength, gaps, earnings, candlesticks, trend lines, moving averages, some of the same things most technicians look at, but we'll throw in a seasonality. We'll throw in that historical perspective from time to time. I think it's very educational. At least that's the way we try to make it, trying to help either teach folks who don't know too much about technical analysis, kind of show them a little bit about what this is all about. And for those of you who already are strong technicians, maybe we can offer some things that'll just kind of help tweak some things, maybe improve your trading. That's the whole idea. Anyhow, signing up to this newsletter offers other benefits. It gets you into any of our free events. If we do a free webinar in the evenings, which we do plenty of them throughout the year, we'll send you an invitation. Everyone on the EB Digest newsletter will receive an invitation to those free events. And I got to tell you, we are about to kick off more and more. We'll be giving you more and more information about an upcoming event on Saturday, January 7th. It'll be our 4th annual Market Vision event. Of course, this one, Market Vision 2023. It will be a free event. It will feature not only me giving you my forecast for 2023, but it'll also introduce you, if you don't already know, some of the folks at StockCharts that I've worked with over the years. So there'll be a lot more information coming out about that, but that's going to be a huge event. Again, it's our 4th annual, and it's free to those who are on the Earnings Beats Digest newsletter. So name and email address, all it takes. You can, there's no credit card required. You can unsubscribe at any time. We'd love to have you. All right, so what happened on Monday? Let's get into this daily market recap. The Dow Jones finished down almost 500 points. S&P 500 down 73, NASDAQ down 221, mid caps down 65, small caps down 35. It was not pretty. The major indices, as you can see, dropped anywhere from 1.4% on the Dow up to 2.77% on the small cap index. So it was not a pretty day. We did come down and close either at, just above, or just below the 20-day moving average across the board here. So I think as we go forward here, the next couple of days, this is going to be a test for the bulls, because we are in positive. We have positive configurations in terms of price action above the 20, above the 50, the PPO above the center line, the AD line strengthening. All these things are good, but the first crack in the foundation would be a drop below the 20-day moving average. Small caps finished at 1210. The 20-day EMA is 1213, so we finished just a couple points below. The mid caps, however, finished at 2509, and the 20-day is sitting at 2507, so a couple of points above. NASDAQ 11240. The 20 days 11154, so less than 1% to that key moving average. S&P back down just below 4,000. 20-day 3967. And remember, this 4,000 level is a big deal on the S&P 500. So is this just a quick little temporary breach, or are we going to see selling accelerate today? That's a big question based on that 4,000 level that we've been looking at and all the pivots that we've seen off of 4,000 in 2022. So do we jump back up above 4,000, hold that 20-day moving average, or are we looking at more consolidation, sideways action, and possibly downtrend ahead? Part of it will be what happens off of 4,000. Then we've got the Dow Jones at 33,947. 20-day on this one's a little bit lower, 33,642. So we've got almost 1% down to that 20-day EMA. Looking at the sectors from Monday, energy down almost 3%. Energy prices, crude prices have been dropping again. And as a result, as we talked about, 50-day moving average is what we'd be looking for, maybe a trip to 84, 85. Well, we're at 87, and the 50-day moving average is at 86, so we're almost there. Got to pay attention to these negative divergences. We actually have slight negative divergences on the Dow. Also on the mid caps, higher prices, slightly lower PPO. Small caps, higher prices, slightly lower PPO. Negative divergences, you've got to be careful, because telling us that momentum is slowing a bit. And sometimes we'll get that drop not just to the 20-day, but all the way down to the 50-day to reset the PPO and to get that 50-day test. So XLE looks like it's doing it. Discretionary, also another rough day, down almost 2.9%. It is back down below both of its moving averages. It finished there yesterday. We need to bounce back up, or it looks like maybe the next move down could be to about 138, 139. That would be the recent low that we saw the latter part of November. Utilities down about 0.5%. This was actually the best performing group. So these next three, as you can see, utilities, healthcare, staples, the defensive groups held up best, which is normal during a sell-off, but it would have been much better had technology and discretionary and communication services been at the top of the list on a sell-off. That would have been a sell-off that I wouldn't have trusted at all to the downside. I would have been expecting a rebound. But this at least shapes up like we see most sell-offs with utilities, healthcare, staples. leading on a relative basis. All 11 sectors, though, were down on Monday. 10-year Treasury yield. We have no significant economic news out today, so this will basically just be trading on its own. Maybe little technical trading here in the short term. And as I look at this chart, we're trending. We're trending below the 20-day moving average. Look at the move that we saw back on, that was November. That was the day after Thanksgiving. We had that move up temporarily, got up to about I think it was 3.8 and change, or actually 3.798. So almost up to that 380 level, which was close to the 20-day moving average, and then another drop. And this drop was significant because if we look at the annotation here, I'll show you. This high right back here in mid-June, we took that out and haven't tested it. So here we came back down and essentially tested it and bounced off of that level, which I would have expected. 20-day moving average, I would say, is your short-term resistance on the 10-year Treasury yield. Currently, that's at 3.75%. To the downside, we've now got this prior resistance, which has become yield support, down at about that. I believe that high is 3.48. So 3.48, I think this low was 3.50. Right in that range is where we should be looking for support. And of course, if we bounce in the yield and move higher, that means Treasury prices are selling off. So we could see some selling. We've seen a lot of movement to the downside. There's been a lot of buying in Treasuries that has sent the yield down to this point. It wouldn't be surprising to see some profit taking in bonds heading into the Fed meeting next week. So profit taking in bonds, and maybe it started yesterday, but that could take us back up maybe into that 375 range. And of course, if the yield moves up like that, that could be a downer for U.S. equities, particularly the NASDAQ, those growth stocks. So short term, that's why I'm wondering what's going to happen here as we head into the meeting next week and into that inflation report on Tuesday. Will traders get aggressively long, or will they be much more conservative and cautious and simply maybe move to the sidelines? Don't know. We're going to find out. But that is the range I would be watching right now on the 10-year Treasury yield. Okay, let's move on. Continue this talking technically with, or start this talking technically with the S&P 500. Here was the move up. I mean, we still got a really nice uptrend in play in the short term. Now, we could look at the longer term weekly chart, and obviously we are still in a downtrend, approaching the 50-week moving average, which I talked about when this positive divergence developed. This lower low and this higher PPO suggested what? 50-period test, in this case, 50-week test. Well, we've just about gotten up there. Where is this 20-week moving average? It's at 39.40. So while we've got 4,000, which we know is a key support level, and if I go back to this area of support, this was a gap up that we saw with the October CPI report when it came out. We gapped up to 38.60. That's a major, that was new fundamental information that came out. We gapped up. That was the open, and we went up straight off of that. And we've continued to set highs. So that gap support is going to be very big. If we fail at the 20-day moving average and we fail at 3,900, remember, we've got 38.60 as the big level there. And going back to that weekly chart, so that's 38.60, and the 20-week moving average is 39.40. So we got a lot of support coming up in this area. If all of those levels that I just talked about, 38.60, 39.40, 4,000, if all of these levels give way, it absolutely opens the door for more selling. Technically, I think you could see a lot more technical sellers coming in. These are all areas where I think you could see technical buyers right now. If sellers swamp those buyers and we take out all of these support levels, that would be a definite bearish development in the market. I don't think we're going to lose those levels, but you have to consider consequences if you do. So you've got to always have, one eye on I was talking about an analogy yesterday, being a defensive driver and how you want to check all your mirrors, make sure what's going on around you so that, you can try to avoid any surprises. And that's the same thing with the stock market. You might think you might be very bullish or you might be very bearish, but you ought to at least be considering the other things that are out there that could prove your conviction to be wrong. For me, price volume is the number one indicator. It is number one. I would say number two would probably be the PPO and maybe relative strength. Maybe they might tie because I want to know what momentum is doing. I can look at the PPO and see momentum. And of course, I always want to see relative strength when I'm looking at individual stocks in particular. And sectors. Anyway, right now we're in this uptrend. I think the market still looks fine. I mean, obviously, long term, we're coming out of a cyclical bear market. Some of you might still believe this is secular. That's fine. Everybody has their own opinions. I believe it's cyclical. I believe it's over. But again, if I'm checking all of my mirrors and I'm looking at everything, I'm watching these support levels that I just gave you. Those are going to be key areas to the downside. So for me, the last line is probably going to be that gap support right down at about that 38.40 area. And the reason I say probably, got the 50-day coming up. Right now, that's at 38.18. I mean, if this comes up to 38.35 and 38.40 is lost, then obviously the 50-day is going to be another key area of support as well. But losing all of that definitely would change the dynamics and the market picture. NASDAQ 100, not going to spend a lot of time here. Very similar chart, just haven't seen quite as much strength in the NASDAQ. It's been a little surprising because rates, yields have been dropping. Yields going up were the main reason or one of the key reasons why the NASDAQ 100 was underperforming during the year. So you would think with rates dropping 80 basis points on the 10-year Treasury yield that the NASDAQ 100 would be leading, and it has not been leading. It's led on a couple of days here and there, but overall it's been an underperforming index. Historically, the fourth quarter tends to favor the S&P and the Dow over the NASDAQ. So some of this could be seasonally related. I do believe that if we continue to see our rates dropping and we get no big surprises out of inflation and the Fed continues to talk a little bit more dovishly, I believe the NASDAQ is about to explode to the upside. Again, just my opinion, but I do. I think the NASDAQ's ready to explode. And the month that normally takes off is January to start the year. So if we do continue to be okay here and meander a little bit higher, even though the NASDAQ may underperform, be ready because January could be the month where we see a lot of movement higher in these NASDAQ stocks and a lot of the growth-oriented areas. That is the historical seasonal pattern. All right. I also mentioned yesterday, I was talking about, and this when I talk about yesterday, I'm talking about the show that I do over at Earnings Beats. You can go over to Earnings Beats on Mondays and Wednesdays and Trading Places Live. Anytime after about 8:45 in the morning, 8:50, the show starts at 9. But if you click on this, it'll bring you into the room. It's free for everybody. Anyway, yesterday in the show there, I was talking about some of the foreign markets and how they're performing. And I mentioned that the S&P 500 does not correlate very well with the Shanghai index in China, and that it's much more positively correlated to Germany. And I didn't show the correlation. I just made the comment. I had questions come in asking me about that and if I could show that visually what I was referring to. So here's a chart of the S&P 500 going back 25 years and the Shanghai as well. And you can just kind of see, here, huge move up, huge move down. Seems like it's kind of going with the S&P. Here it's going down, here it's going down. Here we go into a big rally and not so much. If you look at the correlation, you don't have to try and visualize whether it's matching or not. The correlation is automatically based on how they're performing versus one another. With a look back period, the default is 20 periods. Well, I'm looking at a weekly chart, so it's going to be 20 weeks. And here is the correlation. Anything above this zero line means that the two are positively correlated. Anything below the zero line, and they're negatively correlated. Now, you might look at this and say, well, I think it's spending more time above the zero line than it is the below the zero line. And that might be a true statement, but it spends a lot of time in negative territory, meaning that there's a lot of time these two indexes are going in opposite directions. So what this means to me is when you get someone on CNBC saying, oh, well, something's going on in China and that's going to negatively impact the S&P 500, think about this chart, because I don't think there's a lot of positive correlation that you can take out of this. I wouldn't necessarily be looking for things in China to drive what's going on here in the US, because historically it's proven that that is not the case. Now, let me show you the German DAX. So let's pull the DAX up here and look at the correlation on the DAX. And you tell me if the US market is more positively correlated to Germany or to China. Here's the S&P 500. Here's the DAX. Now look at the correlation. Do you see a difference? I mean, not only are we positive, but we live up here near 1, which means they go hand in hand. I mean, if you're at just a little bit above 0, that means that there's a slight correlation. If you're up above 0.50, 0.75, and near 1, we're basically saying that the two go hand in hand. So I'm much more interested in what's going on in Europe than I am what's going on in Asia, and especially in China, because of the history of the correlation between the two indices. That's what I meant by this. All right. So I wanted to pull up the strong earnings. I wanted to show you some charts and some, looking back at some of our chart lists that we provide for our members. This is a lot of the research that we do for our members. And if you happen to be an Earnings Beats member and a StockCharts member, all of these chart lists you can actually download right into your account at StockCharts. So all the work we do, for instance, here in this strong earnings chart list, and I just updated this one yesterday, and this was the old list, so I will update this on this account probably later today. But I was showing on this older strong earnings chart list 443 charts that are on this list. We look at every earnings report that comes out for companies that beat top line and bottom line estimates, revenue and earnings per share, top and bottom line. If they beat Wall Street estimates and the stocks are liquid and they get a positive reaction, or they're just in an uptrend, or their group is strong, it can be any of those things. Something technically has to catch our eye. But those are the three key filters for a stock to get on this chart list. And there are 443 of them. We've already vetted the entire market and put these strong stocks on this one chart list. Anyhow, as we look at these, what I wanted to do is just kind of point out some of them that performed really well yesterday. One was Science Applications International. Now, remember, we had a down day yesterday, but SAIC broke out. They actually came out with their latest earnings, which were strong, and you can see the result. Nice breakout there. RSKD, this is Riskified, starting to strengthen off its 20-day. You can see the volume starting to come in. Look at the AD line starting to explode to the upside. So just following some of these top performers, you can start to get a sense of some of the stocks that maybe are beginning to lead the market to the upside. Another one was Geo. This is Geo Group. This is in the specialty REITs area. Now, if you know one thing about December, historically, it's that real estate really likes the month of December. It's a strong sector in December. And here you've got GEO Group, one of the strongest stocks going into December. And if this were to pull back short term, get close to the 20-day, that would be a pretty strong trading candidate, in my opinion. PPO is very strong, great bullish momentum. It's one of the leaders. The AD line strong, volume trends are strong. If you get it on a pullback to the 20-day, that's what I'd be looking for. Anyway, Those are three in the strong earnings chart list. Now I'll go to the strong future earnings chart list, which is just, these are companies that have strong relative strength, but did not beat top and bottom line in their latest quarterly report. So as a result, they're not in the old, or they're not in that strong earnings chart list. And we pick those strong relative performers up in this chart list. So here you've got RVPH. This is Reviva Pharmaceuticals. It may not be for everyone. The stock only traded 450,000 shares yesterday, and it's only a $4 stock. But it is bouncing off the 50 days. Someone who likes risky stocks. I mean, it was a $6 stock a month ago. Pulls back. Now it looks like maybe it's breaking that downtrend. A move through the 20-day would be bullish. ARQQ. This one went down to the 20-day just below, and we came back up with a nice bullish engulfing candle right on the 20-day moving average. This could be an area where the stock moves up. Again, very aggressive, risky stock. You have to understand what you're getting into. This type of stock, if you're retired and you're, basically trading, with an eye more on income than capital appreciation, this is not the stock for you. You do not want these smaller stocks, aggressive stocks. This is a small software company. Again, yesterday traded just 192,000 shares at $7 stock. Not a lot of dollar volume in this stock. You want to be careful. The strong AD, which is our strong accumulation distribution chart list. One of the stocks in there, PCT, one of the big gainers yesterday. Now, look at the AD line. This is one of those cases where what I tell members is when you have a strong AD line and a very weak price, and you have not so great relative strength, it's hard to believe that there's a lot of accumulation taking place when the stock is one of the worst performers within its own peer group. That doesn't make common sense. AD lines are a secondary indicator, not primary. Price action is primary. This stock's got some work to do before I would be excited about it, even though the AD line is strong there. Anyway, those are kind of the stocks that I would be looking at. Just getting used to the chart list. If you download them into your account, take a look at what leads every day, because it's probably going to give you some ideas for stocks to put on a watch list. Earnings spotlight, really nothing here to talk about. GitLab reported yesterday, GTLB. We can take a quick look at this one just to see the reaction. Oh, it's up 17%, $6. So if we go back and look at that chart, $6 takes it back up almost to the 50-day. I don't know if it gets through the 50-day, and based on its relative strength, I'm going to say probably not. I wouldn't be surprised to see a sell-off after the gap up, but we'll see. All right, three you must see real quick. CRM, Salesforce.com, big breakdown yesterday. Don't like this one. Don't like what's going on here. EQT, of course, yesterday was a weak day. Look at EQT. Major support down around $37, and that's where we finished yesterday. Really need to turn around there. Last one, PNC Financial. Rolling back over, we had a nice little trend line here. That seems to be broken with yesterday's move to the downside. Heavy volume, back down below the 50-day. I think the lows down around 143 now could come back into play for PNC. All right, that's it for me. Appreciate everybody tuning in today. Remember, tomorrow I'll be back over at Earnings Beats for your next Trading Places Live. Go over to earningsbeats.com, and after 8:45 in the morning, click on Trading Places Live, and you should see a link to come into the room to join me. I'll start that program at 9 a.m. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.